Today we're looking at an alternate version of exercise 7-15 from page 344 of the textbook on reporting and analyzing receivables. This problem is looking at the account receivable turnover. The problem reads, the following information is from the annual financial statements of Rahim Company. Calculate the account receivable turnover for 2015 and 2016. So we have for the company actually for 3 years, we have their sales and their account receivables at net year end. That's important because in this calculation, even though we're using just 2015 and 2016 numbers, we will also use in our denominator an average of account receivables. So for the average account receivables for 2015, we use both the 2014 number and the 2015 number. Well, you may be asking why. Well, because sales are for an entire 1 year period, but receivables are just for the year end. There are fluctuations in receivables throughout the year. And so to smooth out the fluctuations, we kind of want to know what receivables were more than just at one point in the year. One handy thing is to look at 2 points, the beginning number and the ending number. We don't have the beginning number, but we do have last year's ending number. And we know that last year at midnight 2014, they had 23,700 receivables. Well, on the first moment of January in 2015, they had that same balance of receivables. So with an ending number of receivables for 2015, 27,000, and with the beginning number of receivables for 2015, 23,700, we'll simply add those together, divide them by 2, and we'll come up with the average receivables for that year. We'll do the exact same thing for 2016, so let's take a look. So the account receivable turnover is net sales divided by the average account receivables. And for 2015, we see the data shows we had net sales of 331,000. Divide that by the average of 27,000 plus 23,700, and we'll see that that's 331,000 divided by 25,350, just straight up from math. Divide into that, and we'll see that receivables were actually flipping 13.1 times. So 13.1 times throughout the year, receivables were being all paid out. For 2016, we had 400,000 in receivables. The average for 2016 was the 29,200 from this year's end, plus 2015's ending of 27,000. Add that together, divided by 2, come up with the average. So it's 400,000 in sales divided by average receivables throughout the year of 28,100, which means that receivables flipped over 14.2 times. So receivables flipped a little bit faster in 2016 than in 2013. Well, what does that mean? Is that a good thing or a bad thing? Well, it's a good thing because the quicker that a company collects its receivables, the faster that asset's turning into cash, the faster they have asset called cash to begin the operating cycle all again. Buy more inventory, sell it, likely sell it on credit, collect that credit, get cash to begin the operating cycle over and over again. So the faster that receivables flip, the better it is for the company. Let's take a look at the analysis notes for Rahim Company. It says Rahim Company turned its receivables 1.18 times faster than in 2016 than in 2015. This may indicate that the company has tightened its credit policies or has improved its collections efforts. Also, relative to competitors, the turnover is 11. Rahim is performing much better than their competitors. Competitors are flipping assets 11 times per year, the asset called receivable, while Rahim is doing that 14.2 times per year. So, big indication of liquidity is how quickly receivables can turn to cash. The faster they turn to cash, the more liquid the company is, the more cash it has to run back into the company for other operations. So this is a good thing. Rahim is on a great path.